One domino left. That is all. Just one more push and the whole thing collapses. And here is what nobody is telling you. That final domino, it is not just bigger than the others. It is bolted to every major financial system on Earth. When it falls, and it will fall, there is no government big enough to catch it, no central bank powerful enough to stop it, no bailout large enough to save it. Because this time, the cavalry is not coming. They are out of ammunition, out of money, and out of time. September 15th, 2008. 7:45 a.m. Lehman Brothers, 158 years old, $613 billion in debt, filed for bankruptcy. The largest bankruptcy in American history. By 9:30 a.m., autocracy, the stock market opened in free fall. The Dow dropped 504 points in a single day. 4.4%. Gone. Banks stopped lending to each other. Credit markets froze. Within weeks, the global financial system was on life support. 8.8 million Americans lost their jobs. 40% lost their home value. $22 trillion in household wealth evaporated. It was the worst financial crisis since the Great Depression, and it almost destroyed capitalism itself. But it did not, because the government stepped in. The Federal Reserve cut interest rates from 5.25% to zero. They printed $4.5 trillion out of thin air. Quantitative easing. The Treasury passed a $700 billion bank bailout. TARP. They saved the banks, they saved the economy, they saved the system, and by 2010 the crisis was over, the stock market recovered. Jobs came back, America rebuilt. That was 2008. And here's what everyone tells you. We fixed it, we learned our lesson, we passed new regulations, Dodd-Frank, stress tests, we made sure it could never happen again. The system is stronger now, safer, more resilient. They are lying to you, because 18 years later in 2026, we are facing another crisis. But this one is different. This one is worse. And this time, when the dominoes start falling, nobody can stop them. Let me show you why. In 2008, when Lehman Brothers collapsed, the world had $142 trillion in total debt. That is a lot, but manageable. Governments had room to borrow, central banks had tools to use, there was space to maneuver. By 2026, global debt is $251 trillion. That is an increase of $109 trillion, 77% higher than 2008. And here is the kicker. Global GDP only grew by about 40%. We added debt almost twice as fast as we grew the economy. That is not growth. That is a Ponzi scheme. And it gets worse. In 2008, global debt was 145% of GDP. High, but survivable. In 2026, global debt is 235% of GDP. Let me put that in terms you can understand. If the entire world economy worked for an entire year and gave every single dollar to pay off debt, we would still owe 135% more. We could not even pay the interest. The interest alone on global debt is over $10 trillion per year. That is more than the entire GDP of Germany and Japan combined. Just the interest, not the principal, the interest. And who owes all this money? Everyone. Governments, corporations, households, developing countries. 23 countries have debt exceeding 100% of their GDP. 3.4 billion people live in countries where their government spends more on debt interest than on education and healthcare combined. 61 developing countries allocate over 10% of their entire government revenue just to pay interest. Not schools, not roads, not hospitals, just interest on old debts. The United States of America has $38.3 trillion in debt, 125% of GDP. We are paying over $1 trillion per year just in interest. That is more than we spend on defense, more than Medicare, just interest. Japan has a debt-to-GDP ratio of 230%, the highest in the developed world. Italy, 137%. France, 112%. The United Kingdom, 105%. These are not third world countries. These are the richest, most advanced economies on Earth, and they are drowning in debt. But here's the thing about debt. It only matters if you cannot pay it back. And right now, nobody can pay it back. Let me show you why. Commercial real estate, office buildings, the places where people used to work before COVID, remember offices, cubicles, water coolers? Yeah, those are dead, and they are taking the banks with them. In 2026, $930 billion in commercial real estate loans are coming due. They have to be paid back or refinanced. That is 3 times the 20-year average. And here's the problem. Office vacancy rates in America are at 19.4%, the highest ever recorded. Almost 1 in 5 offices is empty. Nobody is coming back. Work from home is permanent. Companies realize they do not need expensive downtown offices when everyone can Zoom from their kitchen. So what happens when a $930 billion loan comes due and the building is worth 30% less than it was when you took out the loan? You cannot refinance. The bank says, sorry, we will only lend you 60% of the new lower value. You need to come up with the difference. Cash, right now. And guess what? Nobody has that kind of cash lying around. So they default, they walk away. And the bank takes the building. But the building is worth less than the loan. So the bank loses money, a lot of money. Right now, commercial mortgage-backed securities, that is, when banks bundle these loans and sell them to investors, have a delinquency rate of 7.29%. That is 6 times higher than regular bank loans. And it is rising fast. There have already been 150 commercial real estate foreclosures in the first half of 2025, the highest since 2014. And that is just the beginning. 60% of apartment loans that were made in 2021 and 2022 are coming due in the second half of 2026. Those were taken out when interest rates were near zero. Now rates are 3 times higher. They cannot refinance. They will default. And here is where it gets scary. 278 American banks have excessive exposure to commercial real estate. That means if CRE crashes, those banks fail. And we are not talking about tiny community banks. We're talking about regional banks with hundreds of billions in assets. Flagstar, Zion Bancorp, Valley National Bank. New York Community Bancorp has 57% of its entire loan portfolio in commercial real estate. If CRE goes down, the bank goes down. Does this sound familiar? It should, because this is exactly what happened in 2008. Except back then it was residential mortgages, subprime loans. People bought houses they could not afford. When prices fell, they defaulted. Banks holding those mortgages collapsed. Lehman Brothers had 30 to 1 leverage. For every dollar they had, they owed 30. When the mortgages went bad, they were wiped out instantly. That triggered a cascade. One bank fails, then another, then another. Credit freezes, panic spreads. The whole system implodes. The only difference between 2008 and 2026 is the asset class. Back then, residential mortgages, now commercial real estate. But the mechanism is the same. Overleveraged banks, falling asset prices, defaults, failures, contagion, collapse. Okay, so we have commercial real estate collapsing in America, China imploding, debt at record highs everywhere. But surely the Federal Reserve can step in and save us, right? They did it in 2008. They can do it again, right? Wrong. Dead wrong. And here is why. In 2008, the Fed had a full toolkit. Interest rates were at 5.25%. They cut them all the way to zero. 525 basis points of cuts. Massive stimulus. Quantitative easing was brand new. They had never tried it before. They printed $4.5 trillion. It worked. The economy recovered. Confidence returned. Crisis over. Fast forward to 2026. The Fed has interest rates at 3.75%. That is it. If they cut all the way to zero, that is only 375 basis points. Less than the cuts they made in 2008. And they cannot even go all the way to zero. Why? Because inflation is still elevated. CPI is at 2.7%. Core PCE is 2.8%. The Fed's target is 2%. If they cut rates too much, too fast, inflation could spike again. And they just spent 3 years fighting inflation. They raised rates the fastest in history. They cannot admit they were wrong and cut them all back. They would lose all credibility. So they are trapped. If they cut rates aggressively, inflation comes back. If they do not cut rates, the economy collapses. There's no good option, just bad and worse. And here's the other problem. Quantitative easing. In 2008, the Fed's balance sheet was less than $1 trillion. They expanded it to $4.5 trillion. It was a new tool, powerful, effective. In 2026, the Fed's balance sheet is still over $7 trillion. They already did QE1, QE2, QE3, COVID, QE. It is exhausted. The impact is diminishing. Every additional dollar they print does less and less. It is like a drug addict. The first hit works great, but you build tolerance. Eventually it stops working. The Fed is addicted to QE, and it is not working anymore. And then there is the political problem. Jerome Powell's term as Fed chair expires in May of 2026. Trump has been attacking him for years, demanding rate cuts, questioning his independence. When Powell's term ends, Trump will nominate someone new, someone more compliant, someone who will do what Trump wants. And what does Trump want? Rate cuts, lots of them, even if it causes inflation. Because Trump cares about the stock market, not the economy, not the long term, just the stock market. And when the new Fed chair comes in and starts cutting rates recklessly, the bond market will revolt. Yields will spike, the dollar will collapse, inflation will return, it will be chaos. But even if Powell stays, even if he is independent, even if he does everything right, he does not have the tools. In 2008, Ben Bernanke had 525 basis points to cut. In 2026, Powell has maybe 150. In 2008, the government had fiscal space. The debt to GDP ratio was 70%. They could afford a $700 billion bank bailout and $831 billion stimulus. In 2026, the debt to GDP ratio is 125%. We are already paying $1 trillion a year just in interest. We cannot afford another bailout. Congress will not pass it. The bond market will not allow it. We are out of ammunition, out of options, out of luck. And here's where the domino metaphor becomes terrifying. In 2008, one domino fell. Lehman Brothers. The government caught the rest. They stopped the cascade. In 2026, there are 5 dominoes, and they are all falling at the same time, and they are interconnected. When one falls, it knocks over the others. Domino 1. Commercial real estate collapses. Banks with CRE exposure fail. 278 banks are at risk. When banks fail, they stop lending. Credit freezes. Companies cannot get loans. They lay off workers. Unemployment rises. Consumer spending falls. The economy contracts. Domino 2. China. Property bubble pops. Developers default. Local governments cannot pay debts. Banks go under. The Chinese economy collapses. They stop importing. Commodities crash. Oil, copper, iron ore, all down. Emerging markets that export to China go into recession. Australia, Brazil, Chile, South Africa, all of them. And American companies that sell to China see revenues collapse. Apple, Tesla, Starbucks, earnings fall, stock prices crash. Domino 3, sovereign debt. Governments are overleveraged. Interest payments are consuming budgets. Tax revenues are falling because economies are slowing. Deficits explode. Bond markets lose confidence. Yields spike. Italy, Japan, the UK, even the United States. Investors demand higher interest rates to compensate for risk, but higher rates make the debt even more expensive. A vicious cycle. Some countries default. Greece, 2010 on steroids. Except this time, it is not just Greece, it is everyone. Domino 4. The Federal Reserve and other central banks realize they are powerless. They cut rates. But it is not enough. They restart QE. But it does not work. Inflation stays elevated. The bond market revolts. Yields spike despite QE. The dollar weakens. Confidence in central banks collapses. People realize the Fed cannot save them. Panic spreads. Domino 5. Geopolitics. As economies collapse, tensions rise. China gets desperate. They might invade Taiwan to distract from internal problems. Russia pushes harder in Ukraine. The Middle East explodes. Iran, Israel, Saudi Arabia. Trade wars escalate. Trump raises tariffs even higher. Supply chains fragment. Globalization reverses. Costs rise. Inflation returns. Central banks are stuck. They cannot cut rates because of inflation, but they cannot raise rates because the economy is collapsing. Stagflation, the worst of both worlds. And here's the cascade. CRE collapses. Banks fail. Credit freezes. Recession. China implodes. Commodities crash. Emerging markets crisis. Sovereign debt crisis. Bond yields spike. Central banks powerless. Geopolitical instability. Trade wars. Supply chain chaos. Stagflation. Depression. The dominoes fall, one after another, faster and faster, until the whole system is down. Now, you might be thinking, okay, this sounds bad, but people said the same thing in 2008, and we survived. We will survive this too. Maybe. But let me tell you why 2026 is different, and why this might actually be the final domino. In 1929, the Great Depression happened because of a stock market crash and bank failures, but the government did not intervene. They let banks fail. They did not cut rates. They did not print money. They raised taxes. They cut spending. Austerity, the worst possible response. The Depression lasted 10 years. It took World War II to end it. In 2008, the government learned from 1929. They intervened massively. They cut rates to zero. They printed trillions. They bailed out banks. They passed stimulus. It worked. The crisis ended in 18 months, but here is the key. They could only do that because they had not done it before. The tools were fresh, the credibility was intact, the balance sheets were clean, the debt was low. In 2026, they have already used all the tools. Rates have been at zero multiple times. QE has been done 4 times. Bailouts have been passed. Stimulus has been spent. The balance sheets are bloated. The debt is at record highs. There's nothing left. The toolkit is empty. And that is why this is different. In 2008, the Fed had ammunition. In 2026, they are out of bullets. In 2008, the government had fiscal space. In 2026, they are tapped out. In 2008, the problem was concentrated. In 2026, it is everywhere. And here's the other difference. Speed. In 1929, information moved slowly. Bank runs took days. Panic spread over weeks. You had time to react. In 2008, information moved faster. but still the crisis unfolded over months. Lehman collapsed in September. The worst was in October. You had weeks to prepare. In 2026, information moves at the speed of light. Social media, high-frequency trading, digital bank runs. Silicon Valley Bank collapsed in 24 hours. Customers withdrew $42 billion in one day, with a phone, from their couch. No lines, no panic on the streets, just clicks, and the bank was gone. When the next crisis hits, it will not unfold over months. It will unfold over days, maybe hours. Algorithms will detect stress. High-frequency traders will sell. Social media will amplify panic. Everyone will try to get out at the same time. And the circuit breakers, the trading halts, they will not stop it. They will make it worse. Because a trading halt is a signal. It says this is bad, really bad. So when trading resumes, everyone sells harder. It becomes a self-fulfilling prophecy. Okay, let me give you 3 scenarios, 3 possible futures, and you tell me which one seems most likely. Scenario 1, muddle through, probability 30%. The commercial real estate crisis gets contained. Banks extend loans instead of foreclosing. Extend and pretend. China stabilizes its property sector. They inject stimulus. Local governments get bailed out. Quietly, no headlines. The global economy slows but does not collapse. The Fed cuts rates 50 to 75 basis points, just enough to ease pressure. Stocks correct 10 to 15%, not a crash. A correction. GDP growth slows to 1.5%, but we avoid recession. Unemployment ticks up to 5%, manageable. By late 2026, things stabilize. By 2027, we are growing again. It is painful, but survivable. Not great, but not catastrophic. Scenario 2, rolling crisis, probability 50%. This is the base case, the most likely outcome. Commercial real estate starts collapsing in the second quarter of 2026. A major regional bank fails. New York Community Bancorp or Valley National Bank. The government steps in, FDIC takes over, but it triggers fears. Are other banks at risk? People start moving money from regional banks to big banks, a slow-motion bank run. Meanwhile, China's property crisis deepens. More developers default. Local governments miss payments. The PBOC cuts rates, but it does not help. Deflation sets in. The Chinese economy contracts. Commodities crash. Oil falls to $50 a barrel. Copper down 30%. Emerging markets go into crisis. Brazil, South Africa, Indonesia. Their currencies collapse. Debt defaults. The Fed cuts rates, 150 basis points to 2.25%. But inflation is still above target. They are constrained. It is not enough. The U.S. enters recession in the second half of 2026. The stock market crashes 20 to 30%. The VIX hits 60. Unemployment rises to 7%. Corporate earnings fall 20%. High-yield defaults spike. It is bad, really bad, but not apocalyptic. The government responds with targeted bailouts, limited stimulus. The recession lasts 18 to 24 months. Recovery is slow, painful. By 2028, we are growing again, but growth is weak. Debt is even higher, and everyone knows the next crisis will be worse. Scenario 3, global financial crisis 2.0. Probability 20%. Multiple triggers hit at once. A major bank fails. China announces a hard landing. Property prices down 30%. Multiple local governments default. Commodities collapse. Oil to $30. Copper down 50%. Emerging markets crisis. Currency collapses. Defaults. Contagion spreads to Europe. Banks with exposure to China and emerging markets go under. Deutsche Bank, HSBC, Standard Chartered, Credit Suisse 2.0. The Fed cuts rates to 0. Emergency meetings. They announce unlimited QE, but the bond market revolts. Yields spike. The 10-year Treasury hits 6%, even with QE. Investors lose confidence in the dollar. They sell treasuries. They buy gold. The dollar crashes. Inflation returns. 7% CPI. But the economy is in recession. Stagflation. The stock market crashes 40 to 50%. The Dow loses 20,000 points. The VIX hits 80. Circuit breakers activate. Multiple times. Trading halts. But when it resumes, the selling continues. Unemployment hits 10%. Mass layoffs. Corporate defaults. Malls close. Restaurants shut down. Real estate prices collapse. 30% down. Household wealth destroyed, social unrest, protests, riots, political chaos. The government passes emergency measures, debt jubilee, helicopter money, capital controls, anything to stop the panic, but confidence is gone. It takes 5 years to stabilize. A lost decade begins. The American standard of living falls permanently. The American century ends. Which scenario happens? I think scenario 2, 50% probability. A rolling crisis, not a total collapse, but not a soft landing either, a hard landing, a recession, a bear market, Pain, but survivable. The system bends, but does not break. Yet. But here is the key. After this crisis, after the next recession, after the next round of bailouts and money printing, the debt will be even higher. The tools will be even more exhausted. The credibility will be even more damaged. And the next crisis, in the 2030s, that one will be worse. That one might be the true final domino. So what do you do? How do you prepare? How do you protect yourself? Let me give you 10 indicators, 10 things to watch. If 3 of these flash red, be cautious. If 5 flash red, reduce your stock exposure. If 7 or more flash red, go defensive. Get out of the way. The crash is coming. Indicator 1, the dollar-yen exchange rate. Right now, it is around 153 to 156 yen per dollar. If it drops below 140, the carry trade is unwinding. Capital is fleeing to safety. If it drops below 130, panic. If it drops below 120, systemic crisis. Watch this daily. Indicator 2, the U.S. 10-year Treasury yield. Right now, 4.35%. If it spikes above 5%, bond vigilantes are attacking U.S. debt. They do not believe we can pay it back. If it hits 5.5%, fiscal crisis. The government cannot afford the interest. Watch this daily. Indicator 3, credit spreads, high yield bonds, junk bonds. Right now spreads are 2.86%. That is the extra interest junk bonds pay over treasuries. If spreads hit 4%, caution. Investors are worried about defaults. If spreads hit 6%, fear. Defaults are rising. If spreads hit 8% or higher, credit crisis. Nobody can borrow. The economy freezes. Watch this weekly. Indicator 4, bank stocks, the regional bank ETF, ticker symbol KRE. If it falls 20% from recent highs, bank crisis is brewing. People are worried about CRE exposure. If it falls 30%, banks are failing. If it falls 50%, systemic bank crisis. Watch this daily. Indicator 5, China PMI, Purchasing Managers Index, a measure of manufacturing activity. Right now it is below 50. That means contraction. If it drops below 45, China is in a hard landing. Recession, depression. Watch this monthly. Indicator 6, the VIX, the fear index, right now 18.6. If it hits 25, caution. Markets are nervous. If it hits 35, fear. Panic is spreading. If it hits 50, crisis. Everyone is selling. If it hits 80, meltdown, systemic collapse. Watch this daily. Indicator 7, the unemployment rate. Right now, 4.4%. If it hits 5%, the economy is weakening. Recession risk rising. If it hits 6%, we are in recession. If it hits 7% or higher, deep recession. Depression risk. Watch this monthly. Indicator 8, commercial real estate delinquency rates. Right now, 1.57% overall, 7.29% for CMBS. If the overall rate hits 3%, crisis. Foreclosures are spiking. Banks are taking losses. If CMBS hits 10%, meltdown. The commercial mortgage market is collapsing. Watch this quarterly. Indicator 9, the Fed funds rate. Right now, 3.5 to 3.75%. Watch how many times the Fed cuts. If they cut once or twice, normal easing. Economy slowing, but manageable. If they cut to 2% or lower, recession. If they cut to 0, crisis. If they do emergency cuts between meetings, panic. Watch this at every Fed meeting. Indicator 10, the Buffett indicator. Total stock market capitalization divided by GDP. Right now, 221%. The long-term average is 100%. Anything above 150% is overvalued. Above 200% is a bubble. If it spikes above 250%, mania. Irrational exuberance. Crash incoming. Watch this monthly. Those are your 10 indicators. Create a spreadsheet, track them, update them. If 3 are flashing red, be cautious. Raise some cash. If 5 are red, reduce equity exposure. Maybe from 70% stocks to 50%. If 7 or more are red, go defensive. 30% stocks, 70% bonds and cash, or even all cash, because the crash is coming. And you do not want to be the last one out. So let me bring this all together. In 2008, Lehman Brothers collapsed. $613 billion in debt. It was the largest bankruptcy in American history. It triggered a global financial crisis. Banks failed, credit froze, stock markets crashed. 8.8 million Americans lost their jobs. The government responded aggressively. The Fed cut rates 525 basis points to 0. They printed $4.5 trillion. The Treasury bailed out banks with $700 billion. Congress passed $831 billion in stimulus. It worked. The crisis ended in 18 months. The recovery took 2 years. By 2010, the stock market was back. By 2012, the economy was growing. By 2015, the crisis was a memory. We learned our lesson. We passed new regulations. We stress-tested banks. We made the system stronger. Safer, right? Wrong. Because instead of fixing the underlying problems, we just added more debt. In 2008, global debt was 142 trillion. Today, it is 251 trillion, 77% higher. Debt to GDP went from 145% to 235%. We did not learn our lesson. We made it worse. And now in 2026, we are facing not one crisis, but 5. Commercial real estate, China, sovereign debt, central bank exhaustion, geopolitical fracturing. And this time, we do not have the tools to respond. The Fed can only cut 150 basis points versus 525 in 2008. QE has been exhausted. 4 rounds, $7 trillion balance sheet. It does not work anymore. The government is 38.3 trillion in debt. We cannot afford another bailout. We are paying $1 trillion a year just in interest. Congress is divided. The bond market is fragile. The dollar is at risk, and the dominoes are falling. Commercial real estate collapses. Banks fail. China implodes. Commodities crash. Sovereign debt crisis. Bond yields spike. Central banks powerless. Geopolitics deteriorates. Trade wars. Supply chain chaos. Stagflation. Recession. Depression. One domino hits another, faster and faster, until they are all down and nobody can stop it, because the cavalry is not coming. They are out of ammunition, out of money, out of time. This is the final domino, and when it falls, there's no government big enough to catch it, no central bank powerful enough to stop it, no bailout large enough to save it. I'm not saying this to scare you, I'm saying this to prepare you. Watch the 10 indicators, track the data, stay informed. If 3 indicators flash red, be cautious. If 5 flash red, reduce your exposure. If 7 flash red, go defensive. Have an emergency fund, 6 months of expenses. Diversify your investments. Do not put everything in stocks. Hold some cash, some gold, some bonds. And if you are close to retirement, be extra careful. You do not have time to recover from a 50% crash, but also do not panic. Do not sell everything and hide in a bunker. History shows that economies recover, markets recover, humans adapt. We survived the Great Depression. We survived 2008. We will survive this too, but it will be painful, it will be scary, and it will change things permanently. The American standard of living might fall. The dollar might lose its status as the global reserve currency. China might overtake us as the world's largest economy. The age of American dominance might end. This might be the final domino of the American century, or maybe not. Maybe we muddle through. Maybe scenario 1 happens. Maybe I am wrong. Maybe the system is more resilient than I think. Maybe policymakers are smarter than I give them credit for. Maybe technology saves us. AI, productivity, innovation. Maybe we grow out of this debt. Maybe everything is fine. But I would not bet on it, because the data says otherwise. The debt is real. The commercial real estate crisis is real. China is real. The Fed's lack of ammunition is real. And the dominoes are falling right now. The only question is how fast and whether you are ready. 1 domino left, just 1. And when it falls, the world changes forever. The question is not if, the question is when, and what you're going to do about it. Stay informed, stay prepared. And whatever you do, do not ignore the warnings, because history does not repeat. But it rhymes. And right now it sounds a lot like 1929 and 2008. And something worse, something we have never seen before, the final domino. Are you ready? If this opened your eyes to what is really happening in the global economy, smash that like button. Subscribe for more deep dives on the financial forces that control your future. Drop a comment. Tell me which scenario you think is most likely. Muddle through? Rolling crisis? Or global meltdown? I want to hear your thoughts. And check out the next video where I break down exactly how to protect your wealth in a crisis. The strategies the wealthy use that nobody tells you about. Thanks for watching. Stay safe, stay informed, and remember, the dominoes are falling. So,